So guys, we started our story of options hedging. In fact, currency options to hedging we have done. One question, small one, easy one you have solved. I think that's question number 2. Take up question number 3. Mark this some important, sir. XYZ Limited, a US firm, will need 3 lakh pounds in 180 days. Sir, a firm will need 3 lakh pounds means it has FC receivable or payable. Obviously, that is FC payable. You are a US company, you have a pound payable. In this connection, the following information is available. Spot rate 1 pound is equal to $2. 180 days forward rate is also given to you. Interest rates are as follows. So UK US 180 days deposit rate borrowing rate is given, and then a call option on pound that expires in 180 days has an exercise price of, sir, that is not 4, is it dollar? Shift you have to hold on keyboard. And premium $0.04. XYZ has forecasted the spot rate 180 days hence as below. So at the 6 months time, spot rate of pound can become any of these 3 rates. In yesterday's sum, question number 2 when we solved, if you look at this point, future spot rate in 180 days is estimated by the consultant at 47.75. Number is directly given, but in this question, number is not directly given, but 3 possible prices along with 3 probabilities are given. Which of the following strategies would be most preferable to XYZ Limited? So one is forward contract, then other one is money market, third one is option hedging, fourth one is no hedging. Show calculation in each case. Brackets are right. Assume 360 days a year. Right, sir. XYZ, a US company, has FC payable of how many pounds? 3 lakh pounds. 3 lakh pounds at 180 days. So alternative 1. Forward hedging. Directly take the 180 days rate and finish it off. So 180 days forward rate. 1 pound is equal to $1.96. So how many pounds we need? 3 lakh pounds. So sort out this. 5,88,000 exactly. Yeah? Okay, this is what? Dollars. This is your outflow at 180 days. So one of the model of hedging is done. Alternative 2. Money market hedge. You are a US company, you have a pound payable, so you have to create a pound receivable by making a pound deposit today. So your step number 1 should be amount of pound deposit to be made. Your goal is if pound ka future value should be equal to your FC payable value, which should be 3 lakhs pound divided by 1 plus pound ka deposit interest rate 4.50.045. So today how much I should deposit so that it will become 3 lakh pounds at the end of 6 months. So sort out this. 399. What is this pounds of pounds? Step number 2. Spot rate today 1 pound is equal to dollar how much is that? 2. So if I have to buy 399 pounds, it will cost me how much today, or how many dollars do I need? Double it. It's $6,798. This much amount of dollars you need. So you will not have, no, you will borrow this. US borrowing rate 5.5% per annum for 180 days. Repayment amount at 180 days should be equal to this will be your ultimate answer. $602 dollars. So this will be your outflow ultimately at 180 days. Step number 4 is deposit made in step 1. Will be used to settle FC payable directly to the supplier at 180 days. This is options hedging. Here, sir, you got to recall what we have discussed in the previous class. So our XYZ is a US company, and this fellow has a pound payable 3 lakhs at 180 days. So if you have a pound payable, you will have to buy pounds at 6 months time by giving dollars at 6 months time. So in future you are going to buy pound, sell dollar. Risk is pound ka buying rate may increase, dollar ka selling rate may decrease. So that will give you 2 routes of hedging. Route 1. Tell me, sir, what is your route 1? So buy call option on pound, or what is route 2? Buy put option on dollar. Go and read the question, sir. Which option did they give you? Who is the underlying asset? Accordingly select either route 1 or route 2. root 1, because very clearly he is saying that call option on pound ka data he has given. If the question had given me data of put on dollar, I would have done that also, but in this sum they have given only call option on pound, so only that. So question provided data of call option on pound as underlying asset. How many pounds you have to hedge? 3 lakh pounds. Okay, so XYZ should buy call option with pound as underlying asset at strike price of call option will give you right to buy pound, no? At what rate? At $1.97. By paying premium of $0.04 per pound. So guys, what will happen on the maturity? Your action today. This is your action today, but on the maturity date, what will happen? In the previous sum, on maturity date, what is future spot rate? Question gave. But in this sum, they have given you 3 future spot rates with 3 probabilities. What should we do now? Multiply the price into probability. 3 prices, 3 probabilities. If you multiply, you will get 1 expected price. So at that 1 expected price, we have to see whether the option is getting exercised or not, payoff we will receive or not. And of course, the required pounds you have to buy in the open market at spot rate. So same thing. Wrong answer. Wrong answer. That's what you learned in derivatives, no? When multiple prices and probabilities are given, while doing options, you should never marry that price into probability. Each price you have to go and check whether the option is exercisable or not. Options hedging, the basic concept. So you cannot do expected price into probability. Sorry, possible price into probability. Why? If you do that, what will happen is you will end up indirectly assuming that option can exercise at all the prices. That will lead into negative payoffs also. That is wrong answer. You laid a nice trap, should not fall in that. Right. At maturity date, the outflow will depend on the future spot rate of pound that would prevail. Question has given 3 possible spot rates and related probabilities. Sir, don't write what I am writing. I'll prepare some columns. You try to understand why so many columns, means why we are preparing what we are preparing. So first one should be, don't write parallelly, watch first. Possible future spot rate means the 3 rates what the question has given. Okay, next. Strike price in, which option is this? Call option. then cost to buy pound at spot rate at 180 days. This and first column both will give you same answer. Fourth column will be payoff received in call option. So if this is your 1, 2, 3, 4. Third column is your outflow because you have to buy pound, because you have to pay pound. Fourth column will be your inflow because your call option may get exercised. Your net outflow will be 3 minus 4. So net outflow at 180 days is equal to 3 is definitely outflow. In case the option get exercised, then some inflow will come. So effectively your outflow will be this. So now you may copy. Sir, you have to pay pounds, so you have to buy pounds. For that you enter into a call option. Call option will give you right to buy pounds. Does it mean that you will really buy pounds under call option? Huh? Physical delivery not possible. No, you have to buy pounds only in the spot market at spot rate. That's the third point. For call option why, sir? In case the rate of pound goes up and up and up, buying outside at spot rate will give me loss. So if I take a call option gets triggered and exercised, and that payoff will recover some of the loss. That's the idea of hedging here. Tell me the three rates. 1 pound is equal to $1.91 and 1 pound is equal to $1.5 and 1 pound is equal to $2.05. Strike price is 1.97. I have to buy pound in the open market. Open market, whatever spot rate is there, that's an outflow. So third column, first column will be same, sir. So $1.91 I will buy each pound. Here each pound I will buy for 1.95. Here I will have to buy for 2.05. It's pakka outflow. There is no doubt on this. Payoff received. First scenario. I have a right to buy at 1.97 each pound, but market pound rate is 1.91. Lapse. So payoff received is 0. Even here also 0. In the last case, market pound rate is 2.05 and I have a right to buy at 1.97. Definitely call will be exercised and we will receive inflow of $0.08. This is inflow. So last step is that 3 minus 4. 1.91, 1.95, 1.97. Now yesterday, even before we started any of the questions, I made a small chart for you. What will happen on the maturity date? Our chart two possibilities are there. One, option may get exercised, means those two possibilities are for a different reason, but in the example we have seen, option may get exercised, option may not get exercised. If the option gets exercised, your outflow will be equal to strike price. You can see in the last case, when the option is getting exercised, outflow is equal to strike price. When the option gets lapsed, your outflow inflow will be equal to your spot rate. So that's all. So spot rate is your final answer or strike price will be your final answer. Bus, you will not have a third case, only these two cases. Now, 3 possibilities are there, 3 probabilities are there. Now you have to bring probabilities. Outside the table you write expected outflow. at 180 days equals to 1.9. What is the probability given? 25%. Can multiply with 25% also directly. This one 1.97 into 15. So 1.943. So 1 pound you are likely to buy at $1.943. Remember ma, averages are always used for analysis. In reality, observe there, life flow and outflow will never become 1.943. 100% will never become. Why it never become? You see, either option will be lapsed or option will be excess. If option is lapsed, then your outflow will be equal to spot rate. If option is excess, your outflow will be equal to strike price. This will never be your real outflow. But for decision making, we should never use the lower number or higher number. We have to use only a average number. A average number, we also call it as expected value in statistics. Hence this. So this is cost of buying pound. To this add option premium. First day you wrote something 0.04. $1.983. How many pounds you got to buy? 3 lakh pounds. Sort out this. 594 900. What is this? Dollars. This is your ultimate outflow. In here you write time value of money ignored on option premium. Sir, if I want, of course you can 100% consider. Study mat, ICA, some size transfer they don't consider because you have two interest rates for dollar. So what they do is they ignore both of them and they'll write a note. If student considers either deposit rate or borrowing rate, they'll give you marks. 100% they'll give you marks. Or you ignore also, you'll get marks. Because if you are ignoring and writing a note, that means that you know that you have to consider that, no? So that's given there. Chalo, this is your outflow. Do the last one. Alternative 4 is no hedging. So if you don't hedge, what will happen? You have to directly buy at spot rate, but you will not have any protection of call option. So this time what you told originally is correct. What is that? 3 spot rates, 3 probabilities, multiply, expected spot rate will come, R rate, Q buy and close it. That is not correct when you are having a option in the background. But in the fourth case, there is no option in the background. So normally you can work out expected spot rate. Looks like this is only better than anything else. 5 lakh, take 6. Which currency is this? Dollars. So compare all the alternatives. Who is better? No hedging is better. Sir, how can no hedging be better, sir? Arey sir, rates are in your favor. So maybe no hedging only is better. See, actually call option was better. But why call option failed here is, here effectively your purchase cost of pound is only 1.943. Whereas in the last case it is 955. But call option is failing because of premium. Forward rate is higher, money market interest rates are disadvantages for you. Conclusion. No hedging is preferred due to lower outflow. Okay, sir. Question number 3 also you did. Nice. Question number 4 is there, 5 is there. Okay. You want easy question or difficult question? 2 choices. Difficult, huh? Till now whatever you have done, no sir, yesterday's sum and this sum, these are not original. We just like that, just to make you feel comfortable. Music starts now. Come to question number 5. It is less music only. Start. Enjoy. What you can do is, you can close your eyes and randomly pick up any MTP, RTP question will be there. Exam did not come recently, so it is highly due. After so many times it waged war in MTP, RTPs, exam rate could not come. In November, next May, somewhere the question is going to appear as it is. Numbers also they won't change. So you can mark it and see. Sir, your astrologer, sir, exactly. Sir, full paper you can guess. No, sir, no, I can't. The problem with FRL we can do some extent, but SFM is little difficult. Because what happens is, in SFM you don't have 16 marks questions. You have 8 marks, 6 marks questions, sometimes 10 marks. And you have only 10 chapters. So they will ask question from every chapter. So it's their difficult, guessing becomes difficult. So the question is, in every question, every chapter question will come. Which question will come, which question will not come, you can guess. Based on last 2 papers, but what can come, only base can be formed. Exactly, it's little difficult. Of course, you can try something. But if once I did, some fellow studied only that and went. So this type of people will be there. Anyway, we'll see, sir, later on. For that also there is one technique where you have to put some numbers and all, like a visa board. You know visa board where you call spirits, like that you can play. We'll try that once. Okay. An American firm is under obligation to pay interest of CAN dollar 10,10,000 and CAN dollar 7,05,000 on 31st July and 30th September respectively. Okay. So American firm, so you're a US company, you have an obligation to pay FC payable. That two FC payables. You should not say they both are adjacent countries, also let them, not like that, you have to do. The risk is, the firm is risk averse and its policy is to hedge the risk. Policy is to hedge the risk involved in all foreign currency transactions. The finance manager of the firm is thinking of hedging the risk considering 2 methods, fixed forward or option contracts. It is now June 30. So today you are standing on end of June. So one payment is on 31st July, just 1 month. Another payment is on 30th September. So July, August, September, 3 months. So 1 month FC payable you are having, 3 months FC payable you are having. following quotations regarding exchange rates US dollar per CAN dollar of the firm's bank were obtained. So today's spot rate 1 CAN dollar is equal to so many US dollars. Like that for forward rate, 3 months forward rate is also given to you. So the forward contract rate, leave it. Next, the price for a US dollar by CAN dollar option on US stock exchange brackets low cents per CAN dollar payable on purchase of the option. Contract size is CAN dollar 50,000 are as follows. A table of what is given you see. 3 strike prices they have given. Call options relating to July, call options relating to September, puts relating to July, puts relating to September. Now, if you go on reading this, our table will be very scary, sir. Look at this first. We are which company? US company. We have a pound payable, CAN dollar payable. So tell me, what risk do I have? I have a CAN dollar payable, so I have to buy CAN dollar by giving US dollar. So CAN dollar may rise or US dollar may fall. What is your hedging route 1? CAN dollar may rise. Buy a call option on CAN dollar. Route 2, normal dollar will fall. So buy a put option on US dollar. So you have 2 choices, sir. Call option on CAN dollar or put option on US dollar. Till here clarity is there. Now, a table above one line is printed. Read. Price for a US dollar per CAN dollar option on a US stock exchange. Brackets low. Price for option means what, sir? Option premium. So, a table whatever you are seeing inside on the option premiums, calls and whatever numbers they wrote, puts and whatever numbers they wrote are the option premium. That is given in cents per CAN dollar. Payable on purchase of the option. Look at this, more clearly hint is given. Contract lot size is in CAN dollar. If lot size is CAN dollar, underlying asset is also CAN dollar. So your hedging will be done using route 1. You have to buy call option on CAN dollar. Are you understanding, sir? Idantha trap. You don't shake off. Trap. Put option CAN dollar, why will I buy, sir? I have to either buy call option on CAN dollar or put option on normal US dollar. They gave you puts for CAN dollar as underlying asset. Don't touch that. Adi trap. Here, why 2 columns are given? Because I have a 1 month FC payable which is at the end of July. I have a 3 months FC payable which is the end of September. So I needed 2 calls now. So 2 series they have given. Sir, why 3 strike prices are given? That we have to see. Continue. According to suggestion of finance manager, if options are to be used, 1 month option should be brought at a strike price of 94 cents, which means this one. This only is relevant for you. 1 month option ka strike price. So 1 month option ka all premium also you identified. Next. And 3 months option at a strike price of 95 cents into this one. With so call premium will be this one. And for the remainder uncovered by the options. What nonsense are you talking? What is the meaning of remaining uncovered? Look at this. This fellow is hero also, villain also. Last 2 sums low, lot size is not there. If you have to hedge 3 lakh pounds, nicely full 3 lakhs ka call option you took and you enjoyed. Imagine, sir, I tell you lot size is 70,000 pounds. What will you do? 3 lakh pounds divided by 70,000 pounds, not a whole number. Since it is not whole number, full hedging is not possible. Either you have to take more contracts or you have to take less contracts. This lot size is there. Once take your calculator, sir, write CAN dollar 10 lakh 10,000. 10 lakh 10,000 is the amount of FC what you have to hedge. Oka contract diskunte you will be hedging 50,000 CAN dollars. Divide by 50. 20.20. Tell me, sir, 20.20 you can enter a contract. You can either enter 20 or you can enter 21. He says, language they have to catch that. And for the remainder uncovered. Uncovered means what? You are not doing over hedging. You are doing only under hedging. So round off to the lowest boundary. take 20 contracts. When you take 20 contracts, a 0.2 contract, whatever you are not unable to take up, to that extent your FC payable will remain unhedged. He says, don't worry, we will handle ourselves. The firm would bear the risk itself. For this, it would use forward rate as the best estimate of spot. That means, at 1 month time or at 3 months time, whatever actual outflow is there, they will feel that whatever forward rates are quoted, they will be the real spot rate for this purpose. Which purpose? For this unhedged portion purpose, forward rate only must be treated as spot rate, so that you will identify the outflow and decide whether this is better or that is better. That means forward is better or options is better. Transaction costs are ignored, of course. Recommend which of the above two methods would be appropriate for the American firm to hedge its foreign exchange risk on the two interest payments. Chalo sir, start. Listen guys, sir, you want presentation in a very cute form I can do, but later on you will not understand. In the sense you have to again resolve everything side low, or I'll make you write a detailed answer, hands will pain, but you'll understand. If you want, you can condense it. How to condense it? Answer I printed already. Half side low you can finish it off. ఒక టేబుల్ వేసి వచ్చేస్తుంది. కానీ టేబుల్ వేసి ఎవరికి వస్తుంది అంటే ఎవరికైతే ఆల్రెడీ ఆన్సర్ తెలుసో వాడికి వస్తుంది. సో వెన్ యూ రివైజ్, ఈ టేబుల్ will not help. Sir, then why did you print? I'll tell you, sir. Today table might be useless for you, but after doing 1 or 2 revisions, the moment you see at the question, all the ideas keep on flowing. Immediately on paper you can solve the sum. At the time comparison key is I printed. The ICACS means your MTP answer printed, but that is a bad presentation, sir. In a sense, presentation is not writing neatly, no, or preparing a table. It should be understandable even if you open books after 1 year also. So I will do first one, sir. Second one you have to do, so listen carefully. Question number is which one? 5. Hedging FC payable of CAN dollar 10,10,000 at 1 month. Okay. Sir, your American company, you have CAN dollar payable, so you have to buy CAN dollar by giving normal dollars at 1 month time. So risks, arrow marks a risk also coincidentally. Therefore, the route 1 is buy call option on CAN dollar, or route 2 don't become writer, sir, only holder. So holder will need 2 choices, either buy call option or buy put option. So in this you will be selecting this. Why only this you are selecting is, lot size is equal to how much? 50,000 CAN dollars. Therefore underlying asset is CAN dollars. Sir, the entire thing, if you don't write an exam also, it's perfectly alright. Perfectly alright. The inside for your understanding we are writing, sir. The company has FC payable of 10,10,000 CAN dollars. It should buy call option on CAN dollar at the rate, with strike price of, what did he say? 1 month call option, which strike price you should use? 94 cents and a 0.94. So at a strike price of 1 CAN dollar is equal to $0.94. Sir, how do you know that you have to write like that? Don't you know, sir, US dollar by CAN dollar means how will you write? 1 CAN dollar is equal to so many US dollars. The normal presentation. That's not ISO codes and all. Okay, so normal presentation. Sir, if underlying asset is Infosys, strike price will be there for Infosys share only, no? Like that, underlying asset CAN dollar, CAN dollar ka strike price will be given. So very obvious point. At premium of, how much premium? 94 cents ki 1.02 cents. Okay. 1.02 cents or divide by 100. 0.0102 per candle. Very clearly observe, sir. Underlying asset CAN dollar, premium cannot be CAN dollar. Premium will be in other currency. Premium cannot be in underlying asset currency. So that's very clearly you should be writing that. Normally our thoughts will go like this. Now that you purchased a call option, first day you have to work out premium amount. Don't do that, because there is a lot size given in the question. If lot size is given, you will not be able to hedge the entire full amount of FC payable. So first you have to work out how many contracts you have to take and all. Once you finalize that part, then you have to come to premium and all. So right, sir. Lot size per contract. $50,000 CAN dollars. Therefore, number of contracts to be taken up is equal to, sir, one contract if I take, I'll be hedging 50,000 CAN dollars. I have to hedge 10 lakh 10,000 CAN dollars. So 10 lakh 10,000 CAN dollar divided by 50,000 CAN dollars. So that will be 20.20 contracts. So 20.20. Next line. We take up 20 contracts of call option on CAN dollar. Sir, if you are taking only 20, of course 20.20 not possible, but I took 20. But if you take 20 only, what will happen is, therefore we are hedging FC payable of 10 lakhs only. How 10 lakh CAN dollars? 20 contracts, sir. Each contract low 50,000 CAN dollars per contract. So even though your FC payable is 10 lakh 20,000, sorry, 10 lakh 10,000, you are able to hedge only 10 lakhs using options. This is not possible, simple. So then what to do? What to do? Continue, sir. Unhedged portion of FC payable is equal to 10 lakh 10,000 CAN dollar minus 10 lakhs CAN dollar, 10,000 CAN dollar. Firm takes risk for this. They very clearly told they will bear the risk themselves. That means unhedged. That's it. Now, E stage low, you can work out your premium amount because you know the number of contracts and all. So, premium paid today for options is equal to, what is the premium amount? 0.012 dollar, 0.0102. This per CAN dollar into how many contracts did you take up? 20 contracts into each contract there are 50,000 CAN dollars. So on 10 lakh CAN dollars, this much amount, 10,200. Okay, this is outflow today. Still standing today only. So 1 month time ki what will happen, we don't even know, but already we have discussed this much. At 31st July, maturity. Go and check, sir. Did the question give you any information about future spot rate? Whether option will be excised or lapsed or anything is given? Nothing is given. Nothing is given. I told you what to do. What you have to do? You have to assume that the spot rate will be at such a level where option stands exercised and therefore payoff also will be received. The net effective cash flow, whether inflow or outflow, depending on the receivable or payable, will be equal to your strike price. Our point you have to close. But here one more twist is there. What is that? Option you have taken only for 10 lakh CAN dollars. Another 10,000 is there. That you have to literally buy in the open market without any protection from call option. So first we'll handle that. Outflow for buying 10,000 CAN dollars, which is the unhedged portion. Spot rate at 1 month, $1 is equal to, 1 CAN dollar is equal to, he told you that it will be treated as equal to 1 month forward rate. So 1 month forward rate only you write. So 0.9301 normal dollars. Here clearly I am writing question specified that 1 month forward rate to be used as spot rate for this purpose. అంటే ఈ unhedged portion వరకు treat that. So 10,000 CAN dollars, 9301 dollars is definitely outflow. B, this is outflow for buying the remaining 10 lakh CAN dollars, which is your hedged portion. under this rate. No info about spot rate at 1 month is given. You don't use this one, huh? This approximation is to be applied only for this purpose and question clearly told. Don't bring it here. Here it is not given and not given, that's it. Therefore, we assume that spot rate would be at such a level where option gets exercised and payoff received. So company would buy, write exactly how I am writing, $10 lakh at spot rate plus receive payoff in call option. The net outflow would be equal to strike price. You put any spot rate, your choice, answer will be that only. Provided that spot rate should be higher than the strike price, otherwise option cannot be exercised. So how many CAN dollars? 10 lakh CAN dollars. How much is this? $940,000. That's all, sir. Option hedging is over. So total outflow in option hedging is, start with premium $10,200 we paid, then $9,301 for buying unhedged portion. Hedged portion buying ki $9,40,000. Fill up this. 501 now. Okay. What is the star mark? Designer. Time value of money on option premium. Note. If somebody don't have a choice also actually. Why? Interest rates are not given. Earlier some money market hedge was there in the question, so interest rate was there. Now that also is not there. They don't have a choice also. Now under this only, alternative 2. What is alternative 2? Forward hedging. Poor fellow, never will trouble you. 1 month forward rate. 1 CAN dollar is equal to $0.9301. You have to buy 10,10,000 CAN dollar. Sort out this. 9 30. Oh. That's it. Conclusion. Who is better? Forward. After so much of effort, your options is not getting selected. Doesn't matter, you'll get full marks. You are not really American for no. Character chestunnaru. So conclusion is forward hedging is to be selected. That's it. Put the heading, do on your own. Fast. This time, presentation and all, if you want, you can change. And no, sir, that much creativity, not yet. As it is copy, change the numbers and do. You forgot heading, don't worry, I'll do it. Hedging. FC payable of, how much is this? 7 lakh? At 3 months time. 30th September payable, that is. This time original workings you need not do. Directly start with taking a call option on CAN dollar and all. Should I change the presentation? Because this might be very heavy. Alternative 1. Options hedging. FC payable at 3 months, 7 lakh 5,000 candles. A risk selection, all that over already. So buy call option on CAN dollar at the rate of, with strike price. What is the strike? This time I think he's asking you to select 95. So 1 CAN dollar is equal to 0.95 US dollars at premium of 1.64 cents per CAN dollar. Convert that. $0.064 per CAN dollar. Number of contracts, 7 lakh 5,000 CAN dollars I have to hedge. One contract if I take up, I can hedge 50,000 CAN dollars. 14.1 now. Okay, 10 contracts. Take 14 contracts. Unhedged portion is equal to total FC payable is 7 lakh 5,000 CAN dollars minus you are taking 14 contracts into $50,000, so you will be hedging only for 7 lakhs. So 5,000 CAN dollars unhedged. Option premium paid. So 14 contracts into 50,000 CAN dollars into $0.0164 per CAN dollar. E CAN dollar will die. This is contract, sir. Fine answer to tell. What is this? US dollars. This outflow today, definitely. At 3 months time, cost of buying 5,000 CAN dollars at a prevailing spot rate. One CAN dollar is equal to 0.9356. Net outflow, 1 CAN dollar is equal to 0.95 $25. What is this 0.95? This is your strike price. So 7 lakh CAN dollar. 6 lakhs. Is correct? Dollars. Add all the three numbers. 11,480, 4678, 665,000. 6 lakh. You see, this time the presentation has reduced. If you understand this, next level improvisation is make two amount columns. One for 1 month FC payable, second column for 3 months FC payable. Particulars lone you will write amount column numbers will change. That way size will be same, but both the cases will be solved at once. Like that you have to reduce time. Because if the maximum 10 marks go 12 marks it will come, sir. Not definitely not more than that. For that you cannot go on writing stories there. Story is for your understanding, not for explaining him. You are not teacher there, no. So alternative 2. Yeah, 6 lakhs. Again forward contract. Okay, sir, this is done. Okay. Sir, in this sum, what is difficult? Difficult in the sense where we can make mistake in this. Sir, original thought lone mistake is there and you have to rectify. What is that? Whether I should take call option on dollar or call option CAN dollar or put option on US dollar, our selection lo you cannot afford to make mistake at the very basic level. Because if their mistake happened, rest of it doesn't matter. So first strategy you have to correctly identify based on the lot size given in the question. Lot size, underlying asset given in the question. Underlying asset, how did you identify from the lot size? You can also identify from the premium also. But premium to why I did not write is US dollar ki unit currency is cent only, CAN dollar ki also it is cent only. So the cent, if you see, you will not be able to make out which cent it is. Of course, still hint is given because he used the term cents per CAN dollar. That means price is cents per CAN dollar means that is which cent? US dollar ka cent. So US dollar slow price is given and premiums are all given in US dollar ka cents. So US dollar cannot be your underlying asset. CAN dollar is the underlying asset. Directly your lot size is there. Lot size is given. So based on that lot size also you can identify. So first a mistake you should avoid. Then the lot size and all you will do. As I already told you, first only don't get overexcited and work out the amount of premium. That is wrong. Because until and unless you decide the number of contracts, premium calculation you should not make. Right. And then on the maturity unhedged portion what to do, the question will tell you. So accordingly you will proceed. Hedged portion, if the question gives you future spot rate, you will see whether the option is getting excised or lapsed like how we did in the previous sums and then do. If the question is silent, you have to make this assumption. The assumption even if you don't write also it's okay. But why they are doing that you should know, no, that's the reason I made you write in one alternative, another alternative directly edit. So that's all, sir. Sir, is the maximum summa? No. Next level. What is next level beyond this? Sir, look at the first question ka story correctly, first case ka story correctly. You will understand what type of problem you are going to face in the next situation. Your FC payable is in which currency? CAN dollar. Hedging low call option also is there in CAN dollar only because question low CAN dollar is the underlying asset. So what is the lot size? $50,000. What is your FC payable? 10,10,000 CAN dollars. How many contracts you should take? 10,10,000 divided by 50,000. Directly you did. Fantastic. Imagine, sir. Question they told you lot size is 50,000 US dollars. Tell me, how will you work out number of contracts? Do you understand what I am trying to say? Your lot size is not in terms of, your underlying asset is not your foreign currency. Underlying asset can be home currency also, no? So if underlying asset is home currency, of course you will not take call, you will take a put. That's a different, I'm not asking that. My point is, how will you identify number of contracts? Is it 10 lakh, 10, this is fact, this I cannot change. I want to hedge this only. I want to hedge this only, but hedging I am doing not using CAN dollar but using US dollar. So how many contracts I should take? Tell me, sir, E case low, is it correct? Can I go and do 10,10,000 CAN dollars divided by $50,000? Can I do like that? That is definitely wrong. So what I have to do? Definitely a numerator now I have to convert it into equivalent amount of US dollars. Without doing that, if you go and work out lot size, you are caught there. Sir, how to convert? Which rate I should apply? Which rate I should apply? To do CAN dollars, I have to convert it into US dollars. Otherwise, I will never know the lot. So I have to convert. Which rate? Which rate? No, sir. The contract, no. Which contract is this? Call option. Call option one rate is there, no. Which rate? Strike price. Use strike price and convert this FC payable into your home currency amount at strike price. That you have to divide with the lot size. Then you will get the number of contracts. Like that you have to work out. Are you understanding, sir? He sum it is easy because the FC payable currency, your underlying asset currency, both are same. Yesterday example also I wantedly gave that example because you are having FC receivable in dollar. I made you do some put option on dollar. I did not bring rupee into picture because at that stage understanding that is very difficult. So each stage now you will be able to understand. In this one more twist is there. You know what is that? Sir, ఇప్పుడు lot size US dollar ఉంటే premium will be in which currency? CAN dollar. So this will be CAN dollar per dollar. So when you work out premium, this won't be $10,200. Let's say this will be 10,200 CAN dollars. You have to pay today. But who are you? US company. You have to, after doing all this effort, you are having CAN dollar payable right now. How will you pay CAN dollar? US company. Spot rate you have to buy and pay. One more extra calculation will come. So your sum will become double now. One small change. What is that? Change the underlying asset. You will have to do extra 10 minutes of calculations. First every time lot size you have to do there and here also. So that's interesting. Let's take up question number 1. Long back exam lo came. Recently go RTP MT facility is there. Whatever adjustment I told you now, some adjustment is there in this sum. That fellow is playing a satire on you. Read. Best of luck. So, kotte mundu cheppi kodtaru sir. Best of luck limited of UK has imported some chemical worth US dollar 364,897 from one of the US suppliers. Imported. Pakka FC payable. The amount is payable in 6 months time. The relevant spot and forward rates are spot rate, forward rate given. The right hand side ka dollar is there, so that is 1 pound is equal to so many dollars. Next, the borrowing rate in UK, US are given. Deposit rates are also given. Look at this. Currency options are available under which one option contract is for GBP 12,500. Who is GBP? Pound. Lot size is given in pound and you are a UK company. That means underlying asset is pound, which is your home currency. Underlying asset home currency, but what you have to hedge is foreign currency dollars. Foreign currency dollar payable you are hedging using a contract which is denominated in pound. So a 364,897 you have to convert and then you have to understand the number of contracts. The option premium for 1 pound at a strike price of $1.70 is $0.096 for a 6 months contract. So your option premium is in dollars, sir. Ultimately when you work out, today you have to pay premium in dollars, but dollar is your foreign currency. So again you have to buy dollars in the spot rate and you have to pay. The company has 3 choices: forward, money market and currency option. Which of the alternatives is preferable by the company? Fantastic, beautiful, right? Right, sir. Is a UK company and has a FC payable of 364,897 dollars at 6 months time. Not right, huh? Correct or no? Correct. Okay. Alternative 1. Sir, we'll do option setting first. Huh? Forward money market later on we can do. Because by the time you do that stupid money market hedge, unnecessary calculations and all, You lose focus by the time we come to options. So please finish off this. If someone for making a small favor to you, they give you two-way quote also. So whenever you have to buy at spot rate or on the maturity date, two-way quotes you have to play. Means you can diagram bid rate, ask rate. Say some 8 marks ko 10 marks is enterprise sir. 12 is there. This koncham discussion scope is there. Leave in choice. Means if you know the other question. In some other question, if you know, this is choice, sir. Because the time point of view negative NPV. Chalo. So you are BOL. You look at this fellow's sadism, sir. Currency options are available in the call put japadu. Adi you should already know all that drama. First you write all these alternatives, then you have to decide at the call or put on. There also mistake is sorry, sum is not joke, sir. Sum already are 3 sums perfectly you should understand. Concept you should know. Then you can handle this third bit. Tell me, what are the 2 choices of hedging? Route 1, you will take a buy call option on dollar, or you got to select this one. Why this one is, lot size is given as 12,500 pounds. Therefore, underlying asset is pound. So you'll select route 2. All this, even if you do not write in the exam, perfectly all right. But inside it should be there. So the company should buy put option on pound with strike price of, check the strike price, very slow, 1.70 at premium of $0.096 per pound. Lot size is 12,500. Pounds, sorry. We have to hedge FC payable of $364,897 using a put option with pound as underlying asset. To identify the value of put option contracts to be bought, we have to calculate the worth of FC payable in pound terms using strike price. Hmm. £214,645. To hedge FC payable of $364,897, we have to take put option contracts for value of 214,645 pounds. Therefore, number of contracts. £214,645 divided by 12,500 pounds per contract. Sir, why not 18? Why not 18 means 18 also you can take, but if you have full data, you can take. The question of data is not there. At 3 months time or whatever 6 months time, what is spot rate? They did not give you. If you go and take 18 contracts, what will happen is your outflow will be for $364,897 or whatever you have hedged, but payoff will be for higher amount. A payoff number you do not know. We are doing net basis, no sir. So going for a higher range is risky here. I'll tell you more clearly why you cannot take 18 later on. First, right, the company takes up 17 contracts. Therefore, FC payable hedged is equal to 17 into 12,500 pounds, correct, into, sorry, is equal to, one second, what is the value per pound, sir? Strike price 1.70 into $1.70 per pound. Put your sir. 361.50 dollars. If you take this many contracts, it's as good as you're hedging this much of FC payable. Unhedged portion of FC payable is equal to $364,897 36 చెప్పండి సార్ ఏం చేద్దాం this $3,647 what to do? Say 361,250 I don't have a problem, that fellow is hedged, so we know how to handle that on the maturity. 3,647 what should I do? Sir, company will take risk and I will assume, sir, you can't do that. Why you cannot do that is, in the previous sum he told that the company will assume the risk itself, and he told that at 1 month time when you buy the CAN dollar in the market, spot rate will be something, and some hint he told. If you do not, somehow you don't have any spot rate like that. At 180 days questioner give you expected spot rate, not given. So if you say that this the company will buy directly at spot rate at 6 months time, and I will ask you what is this rate. If you don't tell me this rate, I'll be stuck at some. If you're stuck in options, how can you compare this alternative with forward and money market? So you cannot leave this like that. You got to do. So you don't have a choice, sir. You are forced to the wall to take a forward contract here. You don't have a choice. Sir, I will remain unhedged. At a real time low, if you are really best of luck limited, you remain unhedged. But you are not. You're down character. So here, sir, after 3 months or after 6 months, if I have to buy $3647 from the market, at what rate I will buy? Questioner they did not give. If you do not know that, the alternative you cannot close. Actually, alternative close, how will I compare this with forward contract and money market hits? So I definitely have to close this sum. So we have to assume that. Assumed that forward contract is used for hedging. So currency option hedging lo forward contract hedging. You should not apply your own mind. I want to take risk and all. No, you can't do that. Fantastic, beautiful. Now, up to here, still first of all introduction is sir. Put option premium calculation. At best of luck, చెప్పినప్పుడే మీరు క్యాచ్ చేసి ఉండాల్సింది. You did a mistake, huh? Option premium payable is equal to, how much is premium? Some dollars he gave. So $0.096 per pound into how many contracts are you picking? 17 contracts. Into each contract row 12,500 pounds per contract. Contract will die. Pound will die. Answer will be in dollars. $400 dollars. Option premium payable today and రాసుకోండి సార్. ఇప్పుడు ఈ డాలర్ పాకెట్లో తీసేయడానికి మనం యూఎస్ కంపెనీ కాదు, యూకే. సో టు బై దిస్ ఎట్ స్పాట్ రేట్. It has to buy $20,400 at spot rate. Sorry, spot rate. If you write, that fellow gave you a two-way quote. That fellow sadism ko limit is not there, sir. Look at this one. What he did. After all this effort, no, ikkadena వదిలేయాలి కదా సార్. ఆడు ఇండైరెక్ట్ కోట్ ఇస్తాడు సార్ వచ్చి. I know that I have to buy dollars. So I'll pick up ask rate if dollar ka quote is given. At pound code is started. So anyway, if you want to draw a diagram, up to you. Already too much artist to become today, but still pound you have to buy. Sorry, dollar you have to buy. Pound you have to give. This side obviously bank is there. Bid rate will be selected, sir. Pound is there, bid is selected. Okay. $1 rate is given. Dollar I have to buy. Bank is selling dollar. Ask rate and I will pick up. Dollar rate is not given. Immediately bid rate you can write, but he thought whether you will get or not. I have doubt. So see, for your sake, how much I am writing. You don't know how difficult it is to write neatly for a long time. This is not my original writing. Right. Calculate. 13,0 చిల్లర ఎందుకులే వదిలేసి pounds. Okay. So where did you reach? Nowhere. Still today only. Option premium just you paid. Now at 6 months time. Sir, this sloga shortcut cute guy can we do? Yes. But first one, if you try to be cute, no sir. Lastly, it won't look nice. You'll not understand anything next time when you open. At 6 months time. First thing, cost of buying. Who is it unhedged? Sorry, forward hedged fellow. How much is that? $3,647 under forward contract. So 6 months FR, 1 pound is equal to dollar 1.5455, 1.5609. This time you are smart, you will understand. Bit rate will be selected. Just now you selected, no sir. Malli diagram is meer kodtaru naku telusu. 1 pound is equal to dollar 1.5455. How many dollars? 3647. 360 236 exactly. Okay, pound only. This is outflow. Then cost of buying. How much is the hedged portion? 361 to 50. 361 to $50 at spot rate plus receiving payoff in which option is that? Put option. Net outflow will be equal to strike price. What is strike price? 1 pound is equal to dollar 1.70. Do this, you will be surprised. 361 to 50. The number already there with you. 2,12,500. Catch is on. Sir, you enter into a put option to sell 2,12,500. And the 2,12,500 only you will give other answer, other outflow. Directly one line also we can write. But you know, we can't trust ourselves. Later on the idea will come or will not come, who knows. So, total outflow in option hedging. Add every box. 13063 plus 2360 plus 212,500 total mark 2 3. Yeah, okay, pound. If you do not do this one, you will not know this outflow. When you do not know this outflow, the alternative outflow will be locked, means you will be blocked there. You can't work out this. If you can't work out this, how will you compare with second and third alternative? So that's the problem. One more thing I wanted to tell you. What was that is, sir, when you worked out number of contracts, you got 17.17. I took only 17. Why not 18? Sir, understand. First, E sum lo what is happening, clearly if you observe, you will automatically know why not 18. Sir, if you take 17 contracts, what happened is, a 17 contracts ki you bought at spot rate. It is 17 contracts ka cost, okay, and 17 contracts ka you also received the payoff. Net effective outflow will be strike price for entire 17 contracts. That's the reason you are able to multiply with 361 250. Correct, no? So if you observe correctly, you are buying at spot rate how much dollars? 361 250 dollars. That's nothing but 17 contracts ka equivalent dollars. Similarly, payoff also receiving on 361 250 dollars equivalent. So ultimately outflow also will be for this much of dollar only, like this you computed. If you take 18 contracts, what will happen is, take your calculator, sir. 18 into 12,500 you do. 2 lakh 25,000. Look at this. 2 lakh 25,000 pounds. Okay. 2 lakh 25,000 pounds into 1.7 you do. 3 lakh 82,500. Now that much worth of call options indirectly you are hedging. That's not required, but you did because you rounded upwards there. What problem you will face is, buying you will buy 364 $897 whatever you want, that much only you will buy at spot rate, but the payoff you end up receiving for how much did you get? 380. This much call options hedging you did, sorry, put option hedging you did, and buying is happening only for this many dollars. Now you see, do you really know the spot rate? If you know spot rate, no, your choice. You can do this individually, you will net off. Spot rate man delete, sir. So we are using this base, and a strike price I am to multiply with only one foreign currency amount. I cannot have two amounts there. So you are forced to the wall to assume that lower boundary only. That's why in the previous sum also he told uncovered portion will take the risk ourselves. Why to uncover? First of all, why can't you take over hedging? Is over hedging cheyalante you should know the, or question should give the expected spot rate on the maturity date. Appudu ee two steps individually will work out. That's not wrong. Question of data unte you can do. Question of data not there, round it off to the lower boundary only. Keep some unhedged portion so that either you will bear the risk itself or you will enter into a forward contract and something. So like that you have to close. But here and here the base FC payable should be same. If here and here it is different, you cannot do this. That's the problem. Sure. Next, alternative 1. 3 is over, alternative 1. Some rate 5617, huh? No, not that. 5455. If you want to draw the diagram, I'm not drawing. Bit rate gets selected, sir. I have to buy dollars, you have to pay dollars, I have to buy dollars and give pounds. Quote is given for pound. I am giving pounds, bank is buying pounds, bid rate is selected. How many? 364. 2 lakh 30. So still options hedging is looking better. Of course, one more fellow is there that will not be selected. Alternative 2. As per your ICS study mat, along with Forex chapter, you have to do this also. Already Forex we did for 18-19 classes. To that, this also if you add, by the time only half minds are gone. So Forex whatever are deep, very deep or lengthy concepts I removed there and I parked it here. One more concept is there, forward contract cancellation with FEDA guidelines. That also International Financial Management chapter I added off. You cannot postpone forex to a later date. అది ఫస్ట్ అని చెప్పాలి సార్. ఇమాజిన్ ఈ స్టేజ్లో ఒక 20 days ఫారెక్స్ క్లాస్ మీన్స్ యువర్ ఫోకస్ లెవెల్స్ ఆర్ ఆల్రెడీ అవుట్ అండ్ ఫారెక్స్ నో రిస్క్. ఓకే, హెడ్జ్ దట్ రిస్క్ నో ఫస్ట్లోనే వీల్ షుడ్. సో బికాస్ ఆఫ్ దట్ అవర్ చాప్టర్ splitting here and there, but you don't have a choice. Do money market, I'm not doing this. Money market hedge. Turning pages are money market hedge. The FC payable sum, receivable sum, payable sum. So you have to create a FC receivable. So again, deposit in not pounds, dollars. 364,897 should be your future value. Dollar deposit rate. For how many months? 6 months. Sort out this. 356. So spot rate 1 pound is equal to $1 point. Sir, I have to deposit dollars outside, so I have to buy dollars. If I have to buy dollars, I have to give pound. Quote is given for pound. Bank, I am giving pounds. Bank is buying pounds. Bid rate is selected. Or diagram you draw and feel good. 1.5617. So $356,847. You are right. Tell me this number, ma. How much amount is required? 220. This much money is required. You don't have that money, so you will borrow. UK borrowing rate 7% per annum, 6 months. Repayment amount is 228,512 into 1 plus 0.07 into 6 by 12. 510. That only. This is your ultimate outflow. Step number 4, you write. I'll write final conclusion. FC payable to be hedged using option contracts. Come to fourth question. The very old RTP question, sir. It's a very good question. Small, cute question. Maamul modu. Means really have to think and do. You will understand, obviously. Before we handle this question, small point. You can also write parallel if you want. Sir, there is a call option. Underlying asset, let us say, is A limited share. Okay. Strike price is 200. Maturity is 3 months from today. Lot size also is a irrelevant value. Now, E option today premium is rupees 20. I give you interest rate is 12% per annum. This fellow is a holder of call option. This fellow just bought call option, therefore he became holder. You have to tell me only one computation, sir. What is BEP? Not full form. I want answer. What is call option break-even price? X plus premium or minus premium? Plus premium. So good. Somehow you remember. Even without revising also. That is quite interesting. 220. Now tell me meaning of break-even price. If spot rate on the maturity date becomes 220, then net gain or loss to the holder, and for that matter even for the writer, it will become 0. Net gain or loss formula. We are holder, sir. Payoff minus premium. So at break even price, payoff should be equal to premium amount. Now, at 3 months, if market price is equal to 220, payoff from call option is equal to 220 market price, but I have a right to buy at 200, so 20 is the benefit, minus premium paid today is also 20, so net payoff, or you can call net gain or loss, is equal to nil. Tell me, sir, he's happier, sadder, no feeling? Sad. Why is sad? There is one more information which you did not use till now. What is that? So, knee break even price calculation, you try to recover only the 20 premium what you paid in the form of payoff later on. But a 20 was invested in this option for a period of 3 months. Or on the 20 you lost an opportunity to earn interest also, no? That also you have to recover. Means the normal break even price formula, whatever we study normally, there obviously time value of money is ignored, but time value of money can also be considered. So if time value of money is considered on option premium, then break even price is equal to strike price plus premium into 1 plus PAR. Sir, if I work out net payoff, now I will get gain. No, sir. You will get gain, but that gain is really not gain. Why that's not really gain? That is your compensation for time value of money. Because if you compute in this case only, it will be x is how much? 200. Premium is 20 into 1 plus 0.12 into 3 by 12. I think that's 0.6. So final answer will be 220.6. If you tell me, sir, if market price is 220.6 or 226, sir? 220.6 only, no? If market price is 220.6, his gain or loss will be 0 and his gain or loss won't be 0. His gain will be there to the extent of 0.6. But understand that's not gain. That is the compensation for time value of money, because his money invested, no sir, opportunity cost recovered. Accounting lo gain may be visible, but feeling lo gain or loss is 0. It is time value of money when you consider, sir. If you know this one small point, is sum you can handle. Of course, all this again I'll make you write in type of formula there, but as such, read, sir. A German firm buys a call on $10 lakhs with a strike of DM 1.60 per dollar at a premium of DM 0.03 per dollar. So stop there. You are a German company. German company ki samlo they are using Dutch mark, but they converted to euro long back. Anyway, their home currency is DM in this sum. If you are buying call option on dollar means, why are you buying? Call option on dollar, who will buy? Think reverse lo, sir. If I am buying a call option on dollar, I am scared that dollar will rise. If you are a German company, you are worried that dollar will rise means you are having what? Dollar receivable, payable. Should catch that. This fellow has a dollar payable, so for hedging he took a dollar call option, strike price given, premium given. Fine. Good news at least is that hedging is done using foreign currency underlying asset. So you did not do what you did in best of luck sum. But here interest opportunity cost is 6% per annum and maturity is 180 days. Okay. What is the break-even maturity spot rate beyond which the firm makes a net gain? Break-even maturity spot rate is nothing but break-even price. So work out break-even price normally. Only thing is, now that he gave you 6% per annum, consider the time value of money and do. Chalo sir, right. First bit is easy one only, no? What is the maturity period? 180 days. It has hedged by buying call option on, I'm sorry, somewhere I made a mistake. $10 lakh. Call option on $10 lakh. Sir, please correct it, sir. Above line law also $10 lakh, sir. With strike price of first question, he's asking BEP. Don't follow their solution, they present it differently. We'll do it differently. BEP in call option is equal to X plus premium. Next one, right? BEP in call option considering time value of money on option premium equals to X value X plus premium. If the question gives you continuous compounding, e power RT, you have to multiply, but anyway 1 plus PAR will do for this sum. So strike is 1.60 plus 0.03 into 1 plus, what is the interest rate? Into 180 by 360. 360 days only, sir, the implied there. Solve independently, sir. 1.60 plus 0.0309. 1.6309. What is this? DM per dollar. Sir, on one side we are doing hedging. Why is he making you compute break-even price? Can you guess? Normally we did 4 or 5 questions till now. Nowhere break-even price ka requirement we have, but he made us do break-even price in this sum. Idi hedging sum hai. Why? Guess. You can easily guess. Go to any sum, sir. On the maturity date, call optional outflow is how much? If spot rate is not given, let's say strike price plus premium also you are adding, there is nothing but this one, 1.6 is what? Strike price. 0.0309 is nothing but premium. Of course, time value of money is also considered. The 1.6309, whatever you are seeing, this is the break-even price, but this is also the outflow under call option hedging if the option gets exercised. This is one of the possibility ka final answer. The second bit he will make you use. For that first bit he is preparing you, but he is preparing you in a very different way. This is break-even price, but this number, so answer will come later on. Anyway, you act innocent. B point. Suppose the 6-month forward rate at the time the option was DM 1.62 per dollar. So, okati option hedging. The other one is forward contract hedging. Forward contract hedging, if you select no, this is forward rate. Always forward rate is cute, small, easy. What is the range of maturity spot rate for which option would prove to be better than forward cover? For what range of values would forward cover be better? Sir, what did happen, sir? Look at this. Sir, if you enter into a forward contract, your outflow is fixed or not? Each dollar you will be able to buy at what rate? 1.62 dim. Fixed. In that there is no change. Correct? Leave. Come to option hedging. If you do option hedging, your ultimate outflow on the maturity date will depend on whether option is getting exercised or not getting exercised. Clarity is there? If option is getting exercised, what is your outflow? Strike price plus also premium also. Anyway, you premium paid. But if option is not getting exercised, yesterday we did know, sir. Example we did even before we started any questions. If you do option hedging perfectly and ultimately the option is not getting hedged, you will feel bad. Huh? You should not feel bad. That's actually a good case for you. Your outflow or inflow will be equal to spot rate on the maturity date. Of course, premium cost anyway you paid, that also have to consider. So your final answer will be either strike price plus premium or spot rate plus premium. The question of twist is, sir, he is not asking whether forward is better, option hedging is better. That's not the question here. The question is, how much should be the spot rate where option hedging will be better than forward contract hedging, and at what spot rates forward will be better than option hedging? The reverse question, sir. Normally they will give you one spot rate and they'll ask you who is better. This time spot rate you have to calculate where option hedging is better than forward contract. Sum ka contents roughly, if you are able to understand, also you will understand the solution. But that solution what is printed down there, I see a solution worst presentation. So we will do in our own style. It will be easy only. Let's see. Chalo sir. Basics are good now sir. Question answer will be solved easily. You will understand surely. Come sir. Second point. ఈ సమ్లో ఫస్ట్ సక్సెస్ పాయింట్ ఇస్ దిస్ సార్, ఈ లైన్. ఇఫ్ యూ క్యాంట్ క్యాచ్ దట్, అసలు ఈ క్వశ్చన్ అండర్స్టాండింగ్ ఈజ్ ఇంపాసిబుల్. వాడు కాల్ ఆప్షన్ హీ బాట్ అంటే వై విల్ బై జర్మన్ కంపెనీ, వై విల్ బై కాల్ ఆప్షన్ హెడ్జింగ్ కేసులో? యూ హ్యావ్ టు అండర్స్టాండ్ ఆల్ దట్ బ్యాక్గ్రౌండ్, దెన్ ఓన్లీ ఈ సమ్ విల్ మేక్ సెన్స్ ఫర్ యూ. ఎనీవే, సెకండ్ పాయింట్ రైట్ సార్. If German company takes up forward contract for hedging its FC payable, its outflow at 6 months or 180 days would be $1 is equal to 1.62 dm. Of course, the per dollar full also work out, not required. Leave it. This you call it as A. B point. If options are used for hedging, the outflow would depend on what? Depend on future spot rate on maturity date. Sir, question of future spot rate not given, what to do? That we know how to handle, but he is not asking that actually. And premium paid is a definite outflow. Sir, I'll make a small table. You will not copy that. You will watch, understand. At once you can copy. Timing, just watch. Sir, particulars, I am taking 2 cases at maturity date. So at 6 months time, case 1, I am assuming that future spot rate is greater than the strike price. What is the strike price given in the question? 1.62 no, 1.60. The forward rates are what you are telling me is 1.60 dm. This is case 1. Case 2. Your future spot rate is some rate which is less than the strike price. 2 cases I will take and I'll see how the analysis will work in options hedging. Sir, I have to pay dollars to somebody. So option will tell me, sir, can I buy dollar under call option? No, I have to buy dollar at spot rate. So outflow for buying dollars at spot rate. What is the outflow? Spot rate. That is nothing but your future spot rate, or simply we'll write FSR. Here also FSR, outflow. Second, payoff received. In call option. Here it is nil because call will be lapsed, because market low rate is cheaper than the strike price, but in the first case option gets exercised. How much payoff will you get? Spot rate minus strike price, so that is nothing but FSR minus strike price. Strike price is how much? 1.60. This is spot rate minus strike price. Correctly, what you have to understand is this is a inflow, this is a outflow. I'm also merging the premium also. Option premium including opportunity cost. How much did you pay? 0.03 into 1 plus 0.06 into 6 by 12. So that is 0.0309. Which, what is this? This is DM. 0.0309 DM. This is outflow or inflow now? This is also outflow. This outflow. This is also outflow. Now add up. What is the total outflow under hedging? FSR outflow minus FSR minus 1.6. FSR will get cancelled, or else if you are having any confusion, let me put like this. The brackets are better than inflow. E brackets ka shape will change. That will do. So FSR minus FSR will die. Minus of minus will have 1.6 plus. This outflow. So this plus. So ultimate answer will be 1.6309 DM. Don't you know this already? When call option gets exercised under hedging, your outflow will be equal to what? Strike price. Premium anyway you paid. Strike price plus premium. Of course, extra what we did here is premium ka time value of money be considered. Bus, that's all. Come to this side. This side answer will be, sir, when option is lapsed under hedging, outflow will be equal to spot rate. That also we know already. Of course, premium anyway we paid. So your answer will be here future spot rate plus 0.0309. This is your total outflow in options hedging. Tell me one thing, sir. Instead of doing all this drama, happily had you taken a forward contract, your outflow would have been how much? Your outflow would have been nicely 1.62 DM. Tell me, if option contract hedging should prove to be better than forward contract hedging, what should happen? Option should be excised, option should be lapsed. See, two cases no. Case 1 ka final answer is how much? 1.6309. Adi outflow. But forward contract outflow is how much? 1.62. Can call option be better than forward contract? In that case, impossible. When the option is getting exercised, call option can never beat forward contract hedging. So case 1 impossible, sir. But case 2 possibility is there. Case 2 how is it possible? Case 2 in the outflow is future spot rate plus 0.039, whereas here outflow is 1.62. Here there is at least a chance that at some spot rate, if it is very low, that low spot rate plus this premium may be less than 1.62. That is the cost of hedging under forward contract. Therefore, option may become favorable than forward contract hedging. So that is possible only when the option is getting lapsed. So now what I will do is, next level, after you copy, they are asking at what range option is better, at what range forward is better. Don't go ranges. Whenever they ask a range, first work out indifference point. What is indifference point? Both the options will give you same answer at what spot rate. So what I will do is, I will equate this to 1.62. I will work out FSR. If FSR is so much, both the options will give you same answer. FSR more than that, forward is better. FSR less than that, call option is better. Khatam over. Like that will present. Clear? Copy this. Very interesting question, sir, but you see, little bit of patience so you have to do. Can't hurry really finish up this. If case 1 prevails, outflow in options hedging will be higher than 1.6309 dm and will be higher than outflow in forward hedging. Actually here strike price is 1.6 only. Who is culprit is a premium. A 0.03 is making these options a bad choice for hedging. So if options hedging should have lower outflow than forward hedging, then it is possible only in case 2. Case 2 not every time, it is possible and we told, that's all. We will identify an indifference point where outflow in option hedging will be equal to outflow in forward hedging. The indifference point rate if you work out, no, then you can work out the range easily. సో ఇప్పుడు సార్ ఇప్పుడు అవుట్ఫ్లో ఇన్ ఆప్షన్ హెడ్జింగ్ ఈజ్ ఈక్వల్ టు అవుట్ఫ్లో ఇన్ ఫార్వర్డ్ హెడ్జింగ్ మీన్స్ యూ కెనాట్ రైట్ దిస్. ఈ కేసు నెవర్ ఇట్ విల్ బి ఈక్వల్. వై ఇట్ నెవర్ బి ఈక్వల్? ఇక్కడ 1.63 సార్, అది 1.62 ఫార్వర్డ్ కాంట్రాక్ట్. హౌ కెన్ ఈక్వేట్ దిస్? ఇట్ ఈస్ ఇంపాసిబుల్. కేస్ 1. కేస్ 2 పాసిబుల్. సో కేస్ 2 ఆన్సర్ యూ రైట్. దిస్ ఈస్ ఫ్యూచర్ స్పాట్ రేట్ plus 0.0309 equated to 1.62. Therefore, future spot rate is equal to 1.5891 dm. Over, sir. Conclusion, last point. If future spot rate is $1 is equal to 1.5891 dm, then both the alternatives are equally good. ఇప్పుడు ఫ్యూచర్ స్పాట్ రేట్ కా point you understood. So above that, below that we'll see. If future spot rate at 6 months is less than 1.5891 dm, tell me sir, who will be better? Look at this sir, then equation. Here if I write 1.5891, left side right side answers will be same. Both the choices are equally good. But if this is less than 1.5891 at 6 months time, left side ka number will be lower than right side ka number. That means options hedging la outflow will be lower. So if future spot rate is less than 1.5891 dm, then outflow in options hedging will be lower than forward hedging, and therefore option hedging is favorable. So 1.5891 is your cutoff point, sir. Similarly, he asked another question. At what range forward is better? If future spot rate at 6 months is greater than 1.5891 dm, gone. In this case, options are bad. Outflow in option hedging will be higher than 1.62 dm, that is forward hedging outflow. Therefore forward hedging is favorable. So the range ke answer is 1.5891 above and below. If you look at the answer, what he did is he somehow worked out 1.5891. How he worked out is he started removing 1.62 minus various levels of prices he see, and he worked out. He prepared a table. This is very confusing presentation. Sir, how will I know that I should try from here to here? At 1.58 they can try చేసుకుంటూ వచ్చాడు sir. Everywhere he went on adding premium. ఇక్కడ 1.61 అయింది, ఇక్కడ 1.6199, 1.62, here also 1.62. So this is your cutoff point and he identified. He did 5 more iterations also and he told below that this is better, above that this is better. అసలు ఈ ప్రైస్కి I should start, ఈ ప్రైస్కి I should end, and how will I know sir? Dream will come on. So the obviously wrong presentation. This is correct presentation. If you want range, first indifference point where they will be equal. If you identify high low, we can see this story, sir. Mark important. Good question. not there anywhere in recent RTPs, MTPs. So maybe exam no chance is there. Enough, huh? Okay. That's all, sir. See you tomorrow.